Between December 2023 and January 2026, Mark Zuckerberg sold exactly $12.3 billion worth of Meta stock. It wasn't a one-off move. It was a series of silent sales, meticulously distributed, precisely while he was appearing in interviews and at events saying that artificial intelligence would be the greatest opportunity of all time for the company. This isn't theory. It's in the official SEC records. The dates, the amounts, the lots. It's all public, but almost no one is paying attention to what this pattern means. And here's the detail that changes everything. Zuckerberg isn't selling because he needs money. He's selling because he knows what's coming. While regular investors continue buying at the peak, excited by the AI hype, insiders are quietly leaving through the back door. And he's not the only one. One by one, executives from Meta, Google, and Nvidia are selling billions. The market pretends it's normal, but it's never normal. By the end of this video, you'll understand exactly what's happening, why these sales are the true barometer of risk, and what the silent pattern is that precedes almost every technological collapse of the last 20 years. What you're about to see is not speculation. It is strategic analysis based on repeated cycles and signals that Wall Street prefers to hide. The number is so high, it seems unbelievable. $12 billion. But it's real. And what makes it even more worrying is not just the absolute value, but the perfect timing. Sales began at the exact moment Meta returned to the spotlight with the hype of artificial intelligence. It seems like a coincidence, but it's not. Mark Zuckerberg didn't sell everything at once. He fragmented the sales into hundreds of small lots over dozens of trading sessions, and that's what almost nobody notices. Most people only see the big headlines. But the real signs are in the quiet details. During this period, he appeared at conferences, gave interviews, and met with CEOs of open-source AI companies, all to reinforce the idea that Meta was at the forefront of the new technological revolution. The public heard hope, but his actions suggested otherwise. This may seem small, but it's not. Zuckerberg sold shares at a time when Meta's valuation was among the highest in history. Earnings multiplier, revenue multiple, projected growth, all above the historical average. In other words, he sold when the numbers were most inflated. And there's a curious fact. These sales happened right after Meta announced growth results in digital advertising revenue, but without detailing how much of that actually came from artificial intelligence. The hype was maintained, but the hard data remained unclear. Meanwhile, most investors remained enthusiastic. Financial influencers, Wall Street analysts, and even institutional funds continued to raise their projections for Meta's shares. The catch? None of them seemed to notice what the company's founder was doing with his own wealth. And here's the central point. What Zuckerberg did isn't a crime, but it's a sign. A clear sign. When a founder with privileged access to all the internal numbers sells billions in silence, while the public narrative is one of explosive growth, it's time to raise eyebrows, because every time this happens, every single time it's the beginning of something bigger. And Zuckerberg's next move had been planned for months. He just needed an excuse to appear normal. And that's where topic 2 comes in. How he did it legally, strategically, and almost invisibly. What protected Zuckerberg most from public questioning wasn't silence. It was legality. All the billion-dollar sales were made through a tool called the 10b5-1 plan. A technical mechanism, complex enough to confuse most investors, but powerful enough to shield any executive. The 10b5-1 plan allows top executives to sell large quantities of shares in advance in an automated way. The official justification? To avoid accusations of insider trading. But in practice, it's the perfect shield for those who want to exit before the collapse without raising suspicion. Zuckerberg wasn't the only one. Several Meta executives also used similar plans in the last 12 months. Interestingly, the plan dates were activated after the announcement of new investments in artificial intelligence, as if the narrative of innovation were the necessary lever to secure internal liquidity. This might seem like a technical detail, but it's not, because every 10b5-1 plan needs to be registered. And you know what almost nobody does? Access these SEC filings, cross-reference the data with public announcements, and analyze the insider behavior patterns. The average investor is always behind the times, because they're always distracted. And here's a game-changing fact. Over 12 months, Zuckerberg sold shares on more than 130 different days. This means that almost half of the trading days on the American Stock Exchange saw a direct movement from him on the selling side. It's systematic. It's precise. It's calculated. Meanwhile, the media touted Meta as the new AI hub, highlighting partnerships, prototypes, and promises. But none of the headlines mentioned the sales volume achieved by the founder himself. Why? Because the sales were within the law. And that's what the market loves. Legality disguised as normality. The 10b5-1 plan was created to protect investors, but it has become the preferred shield for those who want to extract value without alarming the market. A planned sale may seem prudent, but $7 billion, $8 billion, $12 billion? That's more than protection. It's evacuation. And this evacuation was carried out with optimistic narratives, beautiful graphs, and promises of growth. But the question no one is asking is, why sell now if the biggest technological revolution is only just beginning? The answer is in the next topic, and it's brutal. The most troubling point in this story is simple and straightforward. You don't sell $12 billion worth of stocks if you believe the biggest growth is yet to come. And this is where the central thesis behind this whole movement comes in, extracting value before the cycle turns. Zuckerberg isn't diversifying his portfolio. He's strategically exiting a position before the peak becomes visible to the rest of the market. When a founder believes in the company, he holds onto shares. When he knows what the internal numbers show, and they aren't pretty, he sells. It's an old, recurring, but poorly understood pattern. First, a strong narrative, then growth in the stock price. Next, internal sales. Finally, the revelation that expectations were inflated. The market reacts too late, and the insiders are already gone. The most curious thing is that, even in the face of the facts, many people still try to justify it. He already had a lot of concentrated assets. It's just rebalancing. But none of these explanations withstand the test of context, because the sale wasn't made when Meta was down. It was at the height of the euphoria surrounding AI, and it's impossible to ignore that Zuckerberg also sold shares at the company's all-time high before the metaverse crash. In 2021, the movement was similar. Public hype, promises of disruption, mass internal sales, and collapse months later. The pattern repeats itself because it works. The average investor is guided by hearsay, the insider by real data, and those who have access to both choose a very specific moment to make their moves. Always when the market is most distracted and most optimistic. This pre-collapse extraction thesis isn't new, but it has resurfaced strongly in the age of artificial intelligence, because AI today is the new oil of the 21st century, except with a brutal difference. Much of the promise hasn't yet translated into revenue, and insiders know this better than anyone. This is exactly where everything starts to change. When the hype has already been sold, when hope is at its peak, and when the insiders already have their coffers full, the next stage begins market turmoil. And that's what we're going to see in Topic 4. There's a silent system, repeated on Wall Street for decades, that few recognize until it's too late. It has 4 stages and always ends the same way, with ordinary investors holding the account. The name for this, coordinated value extraction. The first step is a change in narrative. The company finds a powerful new theme. Metaverse, Web3, now artificial intelligence. Something promising, difficult to measure, and that seems inevitable. This creates euphoria. Expectations skyrocket. Price multipliers expand. The second stage is disguised internal selling. Executives activate plans like 10b5-1 and begin selling gradually. No alarm, no headlines. Meanwhile, the discourse remains optimistic. Reports reinforce the thesis, and the average investor believes that the insiders are compromised. The third stage is market confusion. Results fall short of expectations. AI revenue metrics don't materialize. Growth slows, but nobody understands what's happening. Analysts blame the cycle, interest rates, the macro environment, but the problem is internal. The fourth stage is the collapse of confidence. The market wakes up. The narrative doesn't hold up. Overvaluation turns into a correction, and when prices plummet, the insiders have already sold. The average investor, who entered at the peak, believing in the future, is the one who absorbs the losses. This cycle happened with Theranos in the healthcare sector, with Enron in the energy sector, with Cisco during the dot-com bubble burst, and now quietly it's happening again, with Meta, Nvidia, and other giants of AI hype. But this time, the stakes are higher, the figures are in the trillions, and investor confidence has already been shaken by recent cycles. This means that when the next downturn comes, it will be faster, deeper, and harder to anticipate. The question is, why does nobody notice this system until it's too late? The answer lies in history. Every time someone shouts, "This time it's different," the end is closer than it seems. And in the next section, we'll see exactly how this pattern has already repeated itself and destroyed fortunes. The idea that insiders sell at the top while ordinary investors buy into the narrative is not new. It just changes its name, sector, and discourse. But the essence is always the same. And the historical examples are brutal. Let's go back to the year 2000. Cisco was seen as the backbone of the internet. The stock was soaring. Everyone wanted to be part of the digital revolution. But while investors were excitedly buying, Cisco executives sold over $800 million worth of stock. The result? The bubble burst, and the stock fell by more than 80%. In 2001, Enron claimed to have reinvented the energy market. It was innovative, disruptive, misunderstood, the typical rhetoric of those trying to mask fraud with pretty words. Meanwhile, executives were selling millions in shares based on internal data unknown to the public. When the truth came out, the company imploded. Theranos, the most recent example. Elizabeth Holmes was celebrated as the new Steve Jobs. Rehearsed speeches, revolutionary promises, investors blinded by the narrative. But behind the scenes, insiders knew the technology didn't work. They quietly sold their stakes. The losses were borne by the funds and the public. And now, with artificial intelligence, the plot repeats itself. Companies inflated by expectations, little real revenue from AI, stretched multiples, and insiders selling billions while the media celebrates the future. It seems different, but it's identical. The detail that almost no one notices is that these sales always precede the fall, never the other way around. No one sells everything when they believe that the biggest appreciation is yet to come. They sell because they know that the narrative is bigger than the numbers support. And this creates a domino effect. When insiders leave, the market loses confidence. When confidence ends, multiples plummet. And when multiples plummet, the fundamentals come to the surface, usually weaker than they appeared. That's exactly what's happening with Meta right now. AI has become the new shield for maintaining stock valuation. But what if that revenue doesn't materialize? What if the models are too open? What if monetization is much more difficult than Wall Street imagines? This is where we enter the most dangerous phase, the difference between rhetoric and real data. And in the next section, we will expose the gap between Meta's promise and what is actually happening within the company. Meta talks about artificial intelligence as if it were an expanding gold mine. But when you look at the numbers, the reality is far less glamorous. The actual revenue generated by AI is still minimal, and almost all of the company's revenue continues to come from traditional digital advertising. This isn't disruption, it's continuity and new packaging. The metaverse, which was the big bet before, consumed tens of billions of dollars and has so far delivered no significant return. AI has emerged as a new promise, but the question no one answers is, what is the sustainable business model for AI within the metaverse? It's still unclear. Meanwhile, the company continues to operate with squeezed margins, rising infrastructure costs, and a very high dependence on a single revenue model, advertising. AI may improve ad efficiency, but that's far from justifying the current valuation multiples. And there's more. Most of the AI advancements that Meta publicizes are open source. That is, free, without direct commercial barriers, and without a guarantee of financial return. This is great for the community, but not for the shareholders who pay for aggressive growth. Even so, Meta's market value rose as if it had discovered the next Google. Price-to-earnings multiples, price-to-sales multiples, and growth projections were inflated by a narrative that has not yet been confirmed in the financial statements. This is where the real risk lies. The investor believes they are buying the future, but they are paying dearly for a present that has barely changed. AI is treated as an absolute certainty, but the data shows that it is, at best, a promise in an experimental phase. Meanwhile, insiders who have full access to internal metrics, such as server costs, adoption time, and monetization potential, are selling shares every month. That says far more than any talk at a tech event. And this is where it all comes together. Hype, internal sales, stretched multiples, and little new revenue. The perfect scenario for a market correction. And that's why the last topic is the most important of all. The final warning for those still exposed to this cycle. The biggest mistake the average investor can make right now is to believe the executives' words more than their actions. Mark Zuckerberg can talk about innovation, the future, and disruption all he wants, but if he's selling billions worth of stock at the same time, he's already made his choice. Professional investors know what matters is not what a company says, but what its leaders do with their own money. And in this case, the message is clear. They are leaving, little by little, discreetly, before the market wakes up. Those still in the market need to ask themselves, am I investing based on real fundamentals, or am I buying into hype inflated by empty promises? This distinction is what separates returns from losses, and history shows that when insiders leave, adjustments follow. Always. Monitoring insider selling isn't paranoia, it's risk management. The SEC publishes daily reports detailing internal transactions. And these reports show a growing pattern of sales at the largest technology companies linked to artificial intelligence. The cycle is progressing. And remember, market corrections don't give warnings. They happen when confidence ends, and confidence ends when the narrative collides with reality. We're exactly at that point. Multiples are high, the new revenue hasn't arrived, and the insiders are already on the outside. You don't need to sell everything. But you need to understand that now is not the time for euphoria. It's a time for strategy, prudence, and a cold, hard analysis of the data. The AI hype may have more chapters, but internal signals show that the easy phase is over. The next phase will be one of separation. Those who understand the cycle will protect themselves and perhaps even profit from the fall. Those who ignore the signs will repeat the story of 2001, 2008, and 2022, buying at the top and selling in panic. Now that you've seen the pattern, the question remains, will you follow the rhetoric or the data? Because while most are captivated by the promising future of AI, insiders are already profiting from the inflated present. Financial empires don't fall by accident. They fall when the pattern repeats itself and almost no one notices. Meta, like other giants before it, entered a cycle known to few and ignored by many. The cycle of narrative, extraction, and collapse. Zuckerberg isn't the villain. He's just playing a game he knows better than most. But when he sells $12 billion worth of his own company's stock while promising the future of AI, the warning has been given. The question is, will you listen? Understanding the technology isn't enough. You need to understand the behavior of those who own the game. They don't need to predict the future. They just need to act before you do. And that's exactly what they're doing. Now, silently. So I ask you, are you buying hope or buying results? Are you following what they say or what they do? Because in cycles like this, understanding is different from acting. If this content sparked your interest, go ahead and subscribe to the channel, and turn on notifications. In the next video, I'll show you how great fortunes change hands during correction cycles and how to identify the beginning of this movement before it's too late.